my name's Debra. I'm with the Property Frontline.
And I'm John Gilmovich from Real Property Manager.
And I'm Ken from Avvora Finance. Welcome to another session of Property Mythbusters, where we're here to bust myths around and misleading information in the property space. And for the next 10 minutes, we'll just be giving you a quick update in terms of what's been happening in each of our respective places. So to kick off, I'll start off with finance. If you haven't already known, there's a lot of competition from the lenders with the fixed rate space. So if you are coming off fixed rates or on a variable rate considering refinancing, I'm not saying necessarily fixed rates are for you. It does depend on your circumstances, but there is a lot of competition in the home loan space for lenders to kind of, from a pricing perspective, they're quite competitive compared to variable interest rates. The other thing that I'd probably mention is lenders probably have gotten their head around a lot of the COVID stuff, and also are starting to have a little bit of more increase in their risk appetite, easing credit policies and things like that. I saw some lenders removing LVR restrictions or loan to value ratio restrictions for certain suburbs. There's also a reintroduction of casual income as long as you've been with the same employer for 12 months. So everything's starting to normalize. There's still a big ticket item, changes to the Responsible Lending Act, which kind of regulates, the issuing, the sale of home loans and credit products. So that's also kind of coming through as well. So it might be a little bit easier to kind of obtain finance in the coming months. And yeah, I mean, that's primarily what's happening from the credit space. There's still a lot of demand. Seems like over 60% of loans have come through the broker channel as well, as opposed to the direct to lender. One thing I'm probably proud of mentioning is that there's a new, it's BID, best interest duty, which has been applied to third-party channels like mortgage brokers in terms of looking after our clients' interests and putting their interests first to make sure that they get a product which is not skewed by conflicting interests and things like that. As you're aware, like if you go directly to a lender, they've only got a suite of products which could pigeonhole you into just trying to jump through a couple of hoops. They don't necessarily need to recommend a more competitive product or a competitor's product for that matter. But as a mortgage broker, because we've got access to different lenders and loan products, now on top of that, we don't necessarily need to make sure that it's suitable, not unsuitable, should I say, the loan product. Yeah, terminology. But also, we're acting in the best interest of our clients, which means sometimes we may have to decline a client in terms of what they're wanting because there is another product out there which is in their interest. So those are some of the things that are happening in the finance space. John, what's happening?
No, before you move on,
No.
I thought it might be worthwhile mentioning, the fact that the market is really starting to speed up and people are really competing for properties. You were telling us about a scenario where people are bidding for properties and then winning and then coming to you for finance, and that's not the way to do it.
Yeah. So that one's an interesting one. So I've had a handful of clients who we've kind of discussed and had a chat, 3 months plus. Never lodged a pre-approval at the time because they were kind of still considering. It was just more of a planning session. And then they've recently kind of contacted me and said they've already bought a property and they want to kind of find the finance. Like you can do that, but it's I don't recommend doing that.
I wouldn't recommend it either.
Yeah, if you're on 100K, 150K income, let's just say, and you're only wanting to borrow $400,000 or $500,000, and your estimated maximum borrowing capacity is say $800,000. So there's a lot of buffer in there.
It's a bit like going shopping, Ken, and you're going to the checkout and you reach out for your wallet and oh my God, I haven't got my wallet.
Yeah,
it's to pay for this.
Exactly. It's like you've got more than enough to pay, but maybe logistically the money isn't in the right account, so you didn't bring the right card. Like it comes down to the details, exactly. So that out of that 150,000 income, the lender might not accept all of it,
Yeah,
or
so
they kind of
there's a lot of risk doing that, isn't there? There's a lot of risk.
There's a lot of risk in doing that. So I would highly recommend not doing that. It gets really stressful. Like with the turnaround times, depending on which lender you go with, there's a likely chance that you won't be able to get conditional approval prior to the cooling off period. So usually we want to kind of get the valuation done and have your loan formally approved by the cooling off period.
Yeah.
Some of the majors are a little bit slow at the moment in terms of picking up files. I think one lender's up to 30 something business days, depending on, if you have a special arrangement, it's a little bit faster, but like that's almost 2 months to pick up a file, but they're prioritizing purchases. So yeah, I mean, it's really, I would recommend not to do it. Just avoid it. It's very stressful.
So get pre-approval first before you start looking.
Yeah, because I think it's the bit that's missing is the research phase. So once we've had a conversation, there's the research phase to see which lender will likely approve the loan, and then the gathering of documents and lodgement that takes time, and then for the lender to pick up and assess. So by getting pre-approval, you kind of eliminate all of those. There's a lot of questions in terms of what you're wanting, the finer details. If you want fixed rates, are you going to lock in, do a rate lock? There's a whole bunch of items how you want to structure the loan that needs to be, discussed and worked out, because it's harder to change things after. It's not impossible. Like once you submit the application, you can change, but it just usually there's full reassessment, and then that causes further delays. So if you can get the lender to assess, pre-approval means that they'll check out your pay slips, your liabilities and things like that. So they'll check, half assess, I guess, your application, because they can't do a full assessment until they get the loan. They get the house, and then they check out the security and make sure that they're happy with where it's located and the attributes. So yeah, so get your pre-approvals, 100%. I recommend if you can. Any more questions, I guess, or hand over to John, see what's happening in the leasing space?
Yeah. Let's take a look at that. I mean, okay, so in property management space, generally from November through to December, even through to late December, instead of kind of things going quiet for us, it actually starts ramping up. Okay, and the reason for that is a lot of things start to happen in people's lives around about December. Yep, it's tied into the New Year's resolutions.
Oh, yeah.
And so there are things that go on, like separations, breakups, change of job, change of location. I want to move. I don't want to be with this person next year. There's a lot that happens on a personal level that basically triggers tenants to want to move. And so it is this year, and even more so, that a lot of vacate notices are coming in, and even break lease notices. So so people are making decisions that I need to change location. It's been a tough year. It's been COVID. I need a change of scenery. I can't live with this person anymore. I don't have enough space. I need a bigger house. I need a bigger property. And to do that, they may need to move out of the Sydney metro areas where I work, and I'm sure this is happening as well in the other capital cities. So this kind of lifestyle change from city to regional is still occurring. Okay, and that's still continuing to put pressure on rents because the vacancies are still relatively high. Now I'm seeing a little bit on social media. I'm seeing them in ads getting pushed out by real estate agents saying, we've got hundreds of properties available.
Wow.
And in this particular agency that I saw in Sydney's in the West, does have a rent book of around 3,500 properties. And I think probably anywhere between 7 to 10% of that rent book could be vacant. So that's one agency potentially dealing with 200 to 300 vacant properties, and that's a huge amount. I was having a chat with a colleague of mine. He happens to be the CEO of the Real Estate Institute of New South Wales. Their membership is real estate agencies across New South Wales. And we're having a chat on, and I said, "What's going on? You know, is the media playing out the right information to the marketplaces? There's data around this disparity between Sydney Metro and the regionals correct?" And he absolutely backed it up and said that his regional agencies are on fire. I mean, that's what he said. There are queues into rental properties. There's actually rental property shortages going on in regionals, in the regional areas, and even on the sales activity, things are going relatively well. So this whole marketplace since about March has absolutely flipped. It's absolutely reversed. City living's no longer as appealing, and I could do a lot better financially while still holding a job or running a business and living in the outer areas. So yes, I think this trend will continue, this kind of lifestyle change, a little bit less pressure on the hip pocket financially to pay less rent. And of course, the current tenants are still negotiating with their landlords in the big cities and getting better deals out there. There are classic examples of tenants now applying for multiple properties, putting in applications, 4 or 5 different applications with different agencies, and then basically sitting out and waiting for the best deal to roll in. So that's look, that's pretty tough on property investors and landlords as well. There's actually no guarantee as such that you're going to get a tenant quite quickly and at the price you want, because it has turned into a tenant's market in the Sydney metropolitan areas. So looking ahead in 2021, what is it going to look like? We happen to have a little bit of statistics that Debra will bring up, and the SQM Research Boom and Bust report has put out some rental stats of what it could look like for 2021, and it's based on a few hypotheses, but having a look there, even the market that I work in Sydney, you can see they're negative almost 7% in the best case scenario for houses. So houses, again, we've looked at this before. There's a bit of a disparity going on between the houses and the apartment markets. So more stock than ever before for the apartment market, adding more pressure on rental discounts going on. So predictions are almost 10%, could come off the ball 10% next year. It's already come off the ball around about 7 to 10% this year on the asking rents. So as you can see, most of Australia is going to be in negative territory around the capital cities, and the ones that Perth, yes, but from an economic point of view, the East Coast is the one that's got the most pressure. Our 2 big cities, Sydney and Melbourne, of course, and and Perth obviously offering a more affordable lifestyle. The predictions are there that rents could rise because demand is rising. So purely from statistical point of view, our two major cities, Sydney and Melbourne, we've got a supply and demand issue, and we've got an oversupply and less demand because there's just not people coming in there's actually more people exiting than coming in into the cities to take up work and studies and so forth. So investors will need to tighten their belt next year if they do own properties in Sydney and Melbourne, and do basically need to, negotiate fair outcomes with their current tenants and try and hold on to their tenants. That'll be my advice. Avoid vacancy, because that's going to be the X factor eating into your returns. It's just unknown how long properties can sit vacant for. So do your best to negotiate and come to terms with the changed marketplace, and that's looking like to continue into 2021 next year.
Okay, all right. Is that it for you, John?
That's it from me.
Okay, all righty. Well, thanks very much for that. So from the purchasing side, it's probably no surprise to anyone, but the market has absolutely exploded. And up until this month, we were kind of saying, well, yes, we're seeing a lot of change in the housing market, but we're now seeing that flow on into the unit market, where people are starting to really push the prices of units up. And I don't know whether that's through good judgment. I think it's through the very good work of some very strategic real estate agents and hardcore marketers. So I think there's quite a few buyers being sold lemons, but anyway, that's the way it goes. Yeah, so we are seeing investors come back into the market. So I'll just share my screen. Got some data here.
I'm starting to see a couple of investor inquiries with home loans and things like that. So
yeah,
that's a positive sign.
It is a positive sign as long as everyone's smart about what they buy. So this is the REA chart that shows activity for searching within the realestate.com.au portal. They're doing some amazing information with their data, but just to sort of point out a few things. So this is where the market was. So this is how many people are actively searching on realestate.com. So if you look at the data for February, so this is the first week of February, and then pretty much February, March, just as the pandemic was hitting. Now, I don't know whether you remember what it was like, but the market was screamingly hot back then, just as, you know, we'd launched into the new year and people were really starting to buy. Then we hit the wall of the virus, and then coming out of it, searches peaked, but it's back up there again. And this is like, so if that was a really hot market, and now we're another 25% hotter than that, that's the reason why we're seeing so much price pressure. But this is the RBA's tracking of housing prices, and you know, just really the bounce is not really showing on this graph yet, but that's probably because we're actually seeing the floor now. And of course, remember the data they get is probably about 2 months old, because they won't report until the sale is actually settled. Yeah, so, but at least the RBA made no change this month. So hopefully they're seeing other data sets other than this one, because that would probably indicate that, you know, the market's still in trouble, and it's way not. In relation to who's buying, so finally we're starting to see this little bit of, oh, can you see my cursor?
Yes. Yep.
Oh, good. Yeah, so finally we're starting to see this little bit of an uptick in activity of investors starting to buy, whereas over the past 12 months, really most of the activity has been with owner-occupiers buying, which, you know, we want to see more of that. That means that there's a lot more people buying their first home. But if the market's already hot and now the investors are starting to dive in, what do you think is going to happen? Once again, you have to be strategic with what you're thinking about buying. Sorry, before we get on to that, that's Lewis's predictions for next year. As an example of what's really happening in the market, and it does show that, again, we've got this cavernous gap between houses and units, that there's properties in quite a range of different suburbs. But my example today is of property out in the Greater Western Sydney area. So let's just call it Penrith. It's not actually that suburb, but there's a property that we bought for a client in August. So it was cash flow positive, and like it's one of those properties that had a renovated house at the front, 3 bedrooms, and then a granny flat at the back with 3 bedrooms. And we bought that property in August for $727,000. Looking for similar types of property now. So, you know, 3 or 4 months later, they're going for about $860,000. And you're coming closer to the city, looking at houses, we're seeing people having to pay sometimes $300,000 or $400,000 over and above the asking price of a property that might be set at between, say, 2 to 2.2 million. You know, if you're like looking at a property and you're getting a guide price of about 2 million, you're probably going to have to pay about 2.4. That's what we're seeing. And so onto the forecast. So a little bit of background. This forecast is about what we're expecting to see that will happen with property prices at city kind of level, so not all the different suburbs. And this data is put together by really the best property market forecaster that we have in this country. So Lewis Christopher from SQM Research, and Lewis has the most, like the best track record over the last, I'd say, maybe 5 to 10 years in forecasting what's going to happen. And he also developed this kind of approach where he will work out his best case and then put some conditions on events that might happen that might impact price. And now, of course, the banks are starting to copy his approach. But anyway, so what he is saying is his best case where the cash rate, so the RBA doesn't change the cash rate, quantitative easing, I don't even want to go into that because that'll be too boring. But anyway, so if the bank isn't printing more money and we control any third wave, they extend JobKeeper and they have a progressive rollout of the vaccine, Lewis is predicting that Perth will increase by 8 to 12%, Brisbane 4 to 8%, Darwin 6 to 9% going up, Melbourne 2 to 6, I think that's too conservative, Sydney 7 to 11%, and you know what, we've already seen that in December, so Adelaide 6 to 10%, Hobart, even Hobart 3 to 7%. I think that's a really unstable market, but anyway. And Canberra increases of 5 to 9%. Then I will just briefly go into his different scenarios, because last year he did the same kind of thing and his worst case scenario was right on the money. So we can really sort of back it. So scenario 2, where JobKeeper is phased out too early, and we do well with the vaccine, and they do control any third waves. They're predicting, but Perth's still championing along. So he's saying that Perth isn't really affected by any of these types of changes, but that Sydney and Melbourne might be still negatively affected. Scenario 3, where we have a better than expected rollout of the vaccine, bounce in employment, and a few other factors. He sees Sydney going up by 3 to 7, while Melbourne's still lagging behind. And then the worst case scenario, is that it? Where there's no vaccine released, international and state borders remain closed, there's a negative cash rate, and job seeker is extended. Even in that scenario, he's saying that Sydney still goes up 4 to 8%, and Perth and the other areas are a little bit more tempered. But basically the story is quite positive, but of course, as we would say every single time, it will be dependent upon where you buy, what you buy, and not only just looking at these top line figures. This sort of information is a piece of information. It shouldn't be something that you base your go, no go decision on, because there's a lot more factors to that. So has anyone got questions about that or comments?
I'd probably mention, yeah, devil's usually in the details. So, I mean, get aggregate stuff and then digging in deeper, just like with the home loan and assessment of incomes and applications. It's always, yeah, at the high level, sometimes it looks fine or sometimes it doesn't look like it's going to happen. But when you look a bit deeper and then kind of, get into the details, sometimes it kind of comes out positive or negative, whichever way, but could change when you look further into the details.
Yeah, but like John was talking about how in certain parts of Sydney there's a lot of lowering of rental returns. So people need to consider that kind of thing when they're investing, and not only that sort of data, but all those other aspects that you should be looking at when you're going to invest money. Even if money is going to be easier to access, you want to be sensible about what you're buying. One of the predictions, or one of the comments that Lewis Christopher has made, is that actually I've got it here, many in the community are starting to think they cannot ever lose on housing. Now, John, you would be like, are you kidding? Like, look at what's going on. So, yeah, so they're thinking.
Absolutely. I mean, I guess, the property market has been buoyant for so long. I think people are starting to forget that, it can change, and there has been times where it has changed and there's been corrections, even though they've been pretty short. The marketplace doesn't keep going up and up and up and up and up. There is points of time, historically, where there's been dips.
Well, I think from this year, though, what has what has underpinned this even more so was the government's very overt moves to keep the market buoyant, and that's what Lewis is saying here. The government will always be there to step into the housing market if they, that the government thinks that the property market is too big to fail. It is a scary idea, as he says, to go into buying willy-nilly thinking that the government
will save you.
or the market, and therefore
Yeah.
investments. Because are they saving those people who bought very expensive units and now can't get the rental returns? They're not saving them, are they?
Not at all. Not at all. There's no help for the property investor.
So you've got to buy a property that will really perform, and then make sure you manage it well with a good property manager, make sure that you're buying a property that will be resilient no matter what happens with the market, and that takes technical skill. But anyway,
and have a safety buffer as well. Like, you actually have to have a safety buffer.
Yeah.
Because there are, we've discussed it in other sessions, but property is an investment. It's a risk, like any other risk, but the risk can be mitigated. But at the same time, you've got to have a safety net. You've got to have a buffer. You've got to have some savings behind you. You just can't bootstrap property.
No, you can't. But anyway, so from on that scary note, it does look like things, as long as you make sensible choices, there are some good opportunities ahead. And anytime there is a really big change in lifestyle, like we are seeing at the moment, there are opportunities, but there's also some people who will get smashed. So do either of you have any thoughts about whether you see this lifestyle change as a permanent thing?
I don't know how many it will affect, Deborah, but there will be, that 30% that will want to make a change. There'll be those that will be sitting on the fence, and there'll be those that will be doing nothing, staying still. So I can see definitely, there's kind of one third sort of scenario where, yes, I think, and I can see it on the ground, that people will make that lifestyle change and make a move. And then there are those that will be watching them, but still thinking about it and not, kind of sitting on the fence, do we, don't we, weighing it up. And there's obviously a lot to weigh up, especially if, you're running a family, and there's going to be a big change of school, change of career, change of job, all those things. And some won't. Some just won't, leave their capital cities, and because the lifestyle's great. It's you've got access to everything. It's convenient, and people love convenience. But city living has its negatives, and we can work through that. And of course, investing in property in your own home in the capital cities, we know historically has done extraordinarily well financially.
Yeah, and of course, with the vaccine being rolled out now, we could be back to kind of normal life in, say, less than 3 months, and we could have a lot more people wanting to move to Australia. Who knows? Certainly, the government will want to encourage that. More migration, but
I mean, we are always seen, from abroad as a a safe island, to come and park yourself and invest and come and live and educate, and we are very attractive. Australia is very attractive.
Yeah. Okay. Alrighty. Well, on that note, thank you very much for watching. We hope you all have the most wonderful Christmas this year, and try and get a little bit of R&R, a bit of rest and relaxation, and check out your financial position and make your plans for 2021. The three of us are available to talk to you to help you make any strategic decisions. Don't try and make these decisions without talking to someone who's really, really active in the market. But basically, that's all from me, and thanks for watching.
Thanks. Bye.